Okay, here's something that the world has not told you yet. I know right now everyone believes that real estate is the number one asset to invest in because you can buy it, you can rent it, you can renovate it, you can refinance it, and you can repeat the process. You can leverage the asset, you can do all of those things. And of course, they disqualify the component where we talk about the debt that's occurred when you're doing a real estate investment. But that's not a bad deal. I've done real estate investment. In fact, the property I'm sitting at right now was initially a real estate investment. But let's just get to the meat and potatoes of this conversation. There's a better asset out there. And what it is called an insurance wrap. Now, many of you may not have heard an insurance wrap, so I'll kind of break it down for you just a little bit. An insurance wrap is typically used on big, large commercial projects. And how it works is every time that contractors on the property, they all have their own independent insurance and assurities and bonds. But what they do is they wrap the entire project to protect the investor should anything occur on that property. Now, over the last 10 months, there's been a strategy brewing to utilize that for small investors, private lenders, real estate investors that makes sense for your deal. And I'm not talking about wrapping the insurance around the property so nothing gets broke while you're fixing it. I'm talking about an investment that's as equal to and actually performs better than real estate. Now, I know people will jump into the comments and you're going to have things to say. That's okay. I'm going to be right in the comments with you and I will respond to what you have to say. So drop your thoughts in the comment. So here's the deal. If I'm a real estate investor and I have $100,000, I will take that $100,000 and I will invest it into a property, maybe 50,000 of it, right? So let's just call that a 10% down, which means it's a $500,000 property. And I use the other $50,000 to renovate the property. Now, I know these numbers are far-fetched, especially in real estate, with that amount of capital. But that same $50,000, the same $100,000, you could have gotten insurance wrap worth 6 times the amount. So that 100,000 would immediately, and I'm saying that, turn into 600,000 or 300,000, depending on how you structure it. So the way that it works is first you become a private lender. It doesn't require regulations. It doesn't require any of that stuff. Now, in your state, yeah, there are some caveats. You have to be certain that you are not loaning too much money or doing too many deals every year. Once you get past a certain number, then you're going to be regulated, right? On the state level, not by the SEC. Number two, your deals are going to be to businesses. So you're loaning to businesses. Okay. Now, we all know that 76% of businesses fail by the year 10. So we always think, well, that's the worst investment. Well, the same thing can happen to a renter in a property, right? The reality is when you rent or when you buy property, you have an asset, which is the real estate, and then you have the income, which we call passive or cash on cash, that flows to you through the deal, which you get every month as long as your tenant's paying and your property's ready to be rented. Okay, you can take that same money and buy or loan. Let's just start at the loan. You'll loan $50,000 to a small business owner. Okay, write that down on your paper. And then you take about $50,000 to $60,000 and you buy an insurance wrap. Now, some people want to say, well, dude, why don't I just buy the insurance wrap? Well, you can. And if you talk with me, I'll tell you exactly how to do that. But right now, I'm showing you the process that's changing the games. Game changer. So here's how this works. You do $50,000, you loan it to a small business owner. You take $60,000, you buy an insurance wrap. The insurance wrap is going to be valued 6 times the loan amount. That's $300,000. So you've essentially put up $110,000 in exchange for $300,000 worth of value. Now, because it's a note, just like a rent, they're going to pay you monthly just like rent. You're going to get that cash on cash just like rent would. The difference is the interest rate on that is going to be somewhere between 12 and 18%. You pick, you decide, you control, just like your real estate deals. You're the one who controls your deals. In this situation, you're the one who controls the deals. You're going to pick your borrowers, you're going to loan to them. That's all you. The only thing you're going to learn from me is strategy, how to do it. And if you're into wealth building and looking about putting money away for the next generation, this is the strategy that you want to use because it has no market correlation. If the market goes down, if the market goes up, doesn't matter. You don't have to worry on tenants and borrowers and interest rates. None of that impacts you. You can get rid of the doors, the toilets, and the management and the headaches around the property and still get an asset that functions just like your real estate asset does for way less price per dollar. Why? Because typically when you go to buy real estate, you're normally paying anywhere between 60 to 70 cents on the dollar. Some people will pay 75 cents on the dollar. If you get into distressed properties, you'll probably end up just a little bit below 50 cents on the dollar, if you're lucky. With this deal, you're paying 20 to 30 cents on the dollar for the asset. So that's unheard of. It is the strongest asset in the economy, in the world. Okay, because insurance, if you think about it, insurance companies don't fail like banks fail, right? When we went through the Great Depression and all of these market declines, guess what? Insurance companies didn't fall. And I know most people say, well, I don't like insurance companies. I don't like insurance. Well, that's okay. You don't have to like it, right? Not everyone likes multifamily houses or apartments. But if it works in your investment model, in your portfolio, then you should consider it, right? So one more time, this is called an insurance wrap. You loan money to a business, then you buy an insurance wrap that wraps the deal, and you end up with a policy that is worth 6 times the loan amount. Okay, so 50,000 turns into 300,000. Okay, and now you have passive cash flow because you have a borrower who's going to pay you back monthly. And then you also have the asset. And just like real estate, at a certain point in time, you can leverage it. You can borrow against it and do it again. So once you've originally put your money into a deal like this, you don't have to put any more money in. The deal will fund itself over and over and over. And the beautiful part of that is not only are you generating revenue right now, today, because somebody's paying you back the loan right now, today, but you also have an asset that is tax-free. See, when you sell that real estate later, there's going to be taxes, right? When you sell that asset or you trade in that policy or that policy pays out, it's tax-free. You don't have that worry. So it is one of the best investment channels that is happening in 2025. This strategy was just deployed at the beginning of the year, so it's new and not everyone hears about it. So you may have saw my other videos where I was ranting about it. Well, I wanted to pause for a second. I know I'm looking a little rough today, but I wanted to rant about it and just kind of give you an insight on what I'm talking about. You know, I normally say, you know, a PVA or protective value asset, but now I've got the point where we know that we can tell you all that it's an insurance wrap. Now, you just can't go out here and there's just some mechanisms to it. You have to have the right contracts. You have to understand how to build the interest into it. So if you don't know how to do that, then it's not going to work, right? Insurance wraps are not going to work. They're going to decline the opportunity for you. You can walk into an insurance company and say, hey, I want to wrap this, and they're going to go, no, we don't wrap like that. So what I show is the strategy and provide the documents and the mechanisms to do that. And you can always reach out to me on a DM just by dropping DCIM in the comments, and I'll reach out to you. But other than that, this strategy is a game changer. It's going to do many things in the world. Number one, it's going to provide capital to small businesses that otherwise could not get it. So when small business owners are looking for funding and the banks are turning them down, and all the people who say, when banks turn you down, we'll say yes, and then you go to them and they still say no, this is going to change the marketplace, right? There's $4.1 trillion funding gap for small businesses. And so the people who understand investing, right, and they know that making money on their money is going to be the best opportunity for them versus running a business. This could be your business. This is going to be the game that plays. This is going to be the actual opportunity that people take a chance to put their money into, because not everybody should be a business owner, right? Some people want to be a business owner because they want to generate money. Some people want to be a business owner because they want to solve a problem. And some people want to be a business owner because they have a passion. Right? So if they're cooks, they want to start a restaurant. If they're trying to just generate money, they're going to hop from idea to idea to idea until they get the money that they want out of it, right? And typically they're looking for short-term returns. And that's okay. You can be like that in investing. What I'm recommending is that you do both, right? You get the short term and the long term without the doors, without the tenants, and without the hassle. There's no advantage in buying real estate over wrapping a loan to a small business owner with an insurance wrap. And if there's anyone out there that wants to dispute that, argue that, fight it, run the numbers, let's go, because we ran the math back 30 years and it works. And so therefore, I just wanted to drop this knowledge on you. Again, if you got any questions, drop it in the comments. Don't forget to subscribe, like, and share this with somebody who will find this interesting.